So my name is Mike Midland, and for those of you who are on the trader trials, I'm going to be your rep. So if you guys have any questions on filtering content, setting up alerts so you can be alerted when Chart places a trade, or just pricing of the service, I can answer those for you. You can email me at mmidland@briefing.com. That's mmidland@briefing.com. So I also wanted to mention that if you have a question for Brett, you can use the chat window to ask him. So no one will see your question but Brett. He's going to try to get to as many as possible. We got a fully packed webinar this afternoon. So if you don't respond after the webinar, we'll get back to you via email. Okay, so now let's just move on to Brett and his analysis and find out, where the next home run trade is going to be, which is pretty much why everyone's on the webinar here. So let me give you a little background. So for those of you who've only been on the trader trial for a week or so, Brett's just been on a phenomenal run. He's going to take you through most of the details of his recent trades, but let me give you some quick highlights so you can get a feel how hot he has been. It basically all started back in December after the Fed rate hike in a quiet November. On the 17th of December, Brett put on 2 quarter positions short on the S&P Jan futures with an average entry of 2064. On January 7th, a few weeks later, he took a profit of 122 points. January 11th, takes off more for 170 points. And then on January 20th, he took off the last for a whopping 250 points. So, just a huge, huge trade. Then, after being bearish on oil for months, Brett got short the DWTI, which is the triple inverse oil ETF, on January 20th at 465 to play for a bounce in oil. This thing went 160 points in his favor in 3 days and as much as 235 points in a little over a week. Up next was a gold call. On the 25th, Brett shorted dust at 17 bucks, and then on February 3rd, he took some profits at 33%, and on the 5th, he took a 52% gain in a week and change. Then, 2 days later, on January 27th, the Fed day, he caught, for him, just a boring 80 points in a NASDAQ short. So, and then lastly, for an encore, on February 4th, I know a lot of you guys caught this trade based on the strong testimonial we had in the site. He shorted the NAS 100 futures with an average price of $41.59, and he took profits of 85, 140, 225, and 210 points in 4 days. So, to put this in perspective, we're talking about 5 monster trades in 4 different trading vehicles in roughly 6 weeks. So, just phenomenal stuff. So, with that, I'm going to toss it over to Brett so we can all find out where this, market might go in the short term and where the next huge trade is. Brett?
Okay, Mike, thank you very much for all the kind words. And I won't mess around any further. Let's just dive right in. So, what I do is I focus on what's called global macro opportunities, which means I look to make big bets for big moves in very big global markets. And I use primarily futures and ETFs. So I trade global equity indices, the S&Ps, NASDAQ, Nikkei DAX, Shanghai, bond markets, gold, oil, copper, commodity markets, and also the foreign exchange markets. And today's webinar is really devoted to trying to filter out the problem setups when you're approaching this way so that you can get involved in trades like this with a lot of conviction and really go after something with confidence, because that's how you make real money in markets. And so the important thing is to have a systematic way to kind of filter out, using all the tools that are available to you from a macro perspective, to filter out the problem trades. So if there's one big unifying idea behind this webinar, it's this. I've been trading for about 16 years, and in that time, I've had a lot of big trades, and I've had a lot of really bad trades. And I'm not going to try to tell you that you can get away from any losses. Losses are completely unavoidable. However, when you've gone through a lot of situations where you have promising setups that look good from so many perspectives, but then ultimately don't work out, you start to notice over time that you've made the same mistake time and time again on one particular dimension of things. So a good example, for instance, is I got a tremendous respect for sentiment data over time, because I was in a situation where something was really obvious to me, and I didn't really realize, years ago, I didn't really realize that it couldn't work if it was really obvious to everyone else too. So I learned to filter with sentiment data, and that's one of the advantages of trading from a macro approach. If you're trading individual stocks, you don't really have quantifiable sentiment data to look at. You also don't have correlations. You don't have politics and macroeconomics quite in the same way. So the big idea here is to use all of those tools to find a systematic way to approach macro trading and macro speculation in a way that filters out setups that are doomed to fail from the start. And that's what I want to go over today. So the big thing is I've come up with a system that I use that I'm codifying for this webinar and perhaps in the future as the 5 key elements of a really strong setup, and that's what I want to go over. So I'm going to go over the 5 key elements. I'm going to go over what it means to have everything lined up, and I'm going to use some real positions and trades with my reasoning and some examples and charts to kind of show how those play together. And then after that, we're going to look at the current market landscape and take a kind of, an inventory of the state of the markets and where maybe some coming opportunities are that fit this system. And then we'll do some Q&A. So the 5 key elements. This is what I found to be a good set of guidelines that help you maximize the odds of having something in play with high conviction that turns out to be right without taking a lot of unnecessary risk. And the first one is what I call falsifiability. And we're going to talk about each one of these in depth right after this and show some examples. But really quickly, the best thing about a good setup is if you can know quickly that you're wrong, honestly. And if you look at all your setups that way, you're going to have a huge edge. Try to favor setups where you can tell that you'll know you're going to be wrong really easily and really clearly. That just rules out all big losses right there off the bat. Second one is what I call thematic logic. And this is about looking at the world that everybody sees as apparent and then thinking just around the next corner to things that are true but people aren't really focused on. So the next world that exists right around that corner. And we'll look at examples of that as well. Larger pattern and mode is the third one. This is really the most important thing here about this is to understand and come to terms with the idea that no major market moves happen because of some headline that day. That's not really what moves markets. Major moves evolve slowly, and they accelerate over time. And they're driven by large financial forces that go on under the surface of the market. You can use day-to-day headlines to try and figure out where that current or that tide is underneath the market. You usually won't fully understand what's driving the market, but you need to respect the idea that something is. When there's a major trend in place, you need to respect the idea that that trend is important, and the day-to-day headlines just serve as ways to show you how strong it is. And the fourth one, sentiment, we talked about this a little bit. We'll talk about this quite a bit more. You basically need to learn to respect sentiment data as an important input. It's crucially important because you'll get involved in a lot of things that you get shaken out in very hard if you overlook this side of it. So we'll look at some details there. And finally, the short-term technical trade trigger pattern. Basically looking at the short-term charts, 3-minute, 5-minute, 9-minute, 15-minute hourly charts, looking at patterns. So once you know everything else lines up, now you're looking for that level break or that breakout pattern or that trend line break or things that show you that the train is now leaving the station on something you have every reason to believe is important. Okay, so a little bit of in-depth on what I'm talking about with falsifiability, and this is just hugely important if you haven't thought about this before. So I'm going to start with a philosopher. His name is Karl Popper. Maybe the most important, most significant figure in the philosophy of science. And here's what he said. His big contribution is this idea of falsifiability. He said, a hypothesis is valid only if it's testable. And a hypothesis is testable only if you understand what proves it wrong. So, for example, you see the picture I have there is a green swan. Now, let's say I've got the hypothesis. Somewhere there exists at least one green swan. How do we test that? Well, let's walk around the whole planet looking at every square foot, seeing if we see a green swan. But, of course, it's an infinite universe. Maybe there's a planet somewhere. It's the planet of the green swans. We don't know for sure. So it doesn't matter that we've looked everywhere and seen no green swans. We still can't prove that that hypothesis is false, right? There's no way to do that, okay? So let me show you how to translate this into trading. Some people use a strategy called reversion to the mean. Long-term capital management, LCCM, great example of this. It was their primary strategy, and it eventually destroyed them. And my thesis is it will eventually destroy anybody who uses this strategy. And the idea is you take a trade in the opposite direction of a move simply because, and for no other reason, that move has gone too far, too fast. Okay? So think of fading a stock that goes way, way up, and you don't know why, but you just see it, and you're like, wow, this thing's got to pull back a little bit. So I'm going to short it. That'll work a lot. But when it doesn't work, it'll destroy you completely. And if you've been through this, you know what I'm talking about. You know, suddenly you're down massively on the day, and you're like, how on earth did this happen? You know, you're covered in sweat, you're screaming at your computer, and you've just lost like $20,000 in something, and there's no reason for it. You just can't help but think, how were you so stupid to let this happen? And I'll tell you how it happened. It went up too far, and so you shorted just a little bit, okay? And you put a stop at the highs, right? And then it popped again, and it went through that stop. So you're taken out of the play. And then it ticks down just a little bit, and you're like, oh, man, I've got to get back in this because now it's an even better setup, right? So you put the stop back at the highs again, and you take the position a little bit bigger because you want to make the money back that you lost in that first attempt now that it's sure to go down. And then you also want to make a profit on the trade. An hour later, you're sitting there realizing you were fading the middle of a strong trend, and the price action of that trend just had you hypnotized. Now, the real problem with the whole situation is that the setup in the first place was not falsifiable. There was no way to disprove the original idea. It went up too far, so it's a short. So if it goes up further, it's just a better short. There's no point at which you can say the whole idea is wrong. So don't take the trade in the first place. If that's the reason why you're taking it, don't do it. There are ways to manage this situation where you think some reversion to the mean is important. So I'm going to show you an example where you can make that falsifiable. So here's a bad trade I took, but it's a good trade methodologically. In November, I bet on a commodity bottom because here was my hypothesis, right? Here was my green swan situation. I believe that the August crash we had in stocks was something that threw everything into such a risk-off framework. I'm seeing some people with problems with sound. Mike, how do you hear me? Everything okay?
Yeah, I'm hearing you fine over here, Brett.
Okay, most people hear me with good sound? Good. Okay, I don't know what's wrong for guys who are having trouble, and that's too bad. And maybe we'll have it mastered well on the recording. I'll do the best I can from here, though. I'm out in California, and I'm talking on my phone, so that's the best I can do. So here's the hypothesis, going back to this trade. In August, we have the crash in the stock market, right? And Dow goes down by 10% in just a few days. And I looked at that as a situation where we've got a long-standing bear market in the commodities, and the commodities at this point are a risk-on asset. In other words, people on the long side are putting speculative capital in there thinking that things will start to look rosier. So that type of fear moment can capitulate or emotionally exaggerate the downside move in the whole commodity space. So my view was the crash in the stock market might have unnecessarily or, let's say, artificially exaggerated the downside in commodities. Now, obviously, this turned out to be entirely wrong, but this is the hypothesis. So we've got the emotional capitulation in DBC in August, and then we've got this sideways range you can see on this chart. And the chart is actually from that day that I put the trade on, so the writing may not make sense. But this is where I bought it, about $14.80. I risked about 50 cents. And that was a testable hypothesis because if I'm right about the emotional exaggeration in that move, there's no way it should get down anywhere near that low. So it's a falsifiable hypothesis. Of course, it didn't work out. It went down 25% afterwards, but I just lost 50 cents. And honestly, if it was right, I was looking for 18.20 on that move, right, over the course of a couple months. So it was a very good risk-reward situation. Okay, thematic logic. So that's falsifiability. Thematic logic. So as I said, this is about seeing around the next quarter. You've got two worlds. You've got the world that's apparent to everybody right now. And then you've got the world that exists just around the next quarter. And I believe it's really important to develop the practice of looking at markets and news and everything else from the standpoint of trying to determine that next world. The things that are important, but that people aren't looking at that closely. And here's some examples of theses that I've had in some of my recent trades. A good one here, for instance, is the second one. We'll look at that more in depth in a second, where the ECB started doing QE, and everybody thought that meant unquestionably the euro had to crash and the German bond market would go through the roof. And, of course, what we got was a crash in the German bond market when everybody realized how crowded that trade was. So here, let's look at a couple of them either way. So the gold shorts, 2014 and 2015, you see the green boxes. Basically, the first green box that you see back in July, essentially, of 2014, that's when ISIS emerged onto the scene. That's when Putin invaded Ukraine. These are huge geopolitical effects. People were starting to talk about the possibility of something like World War III at that point. I don't know if you even remember now because it's such a blip. But there was a couple months there where people every day, all day, on all the networks, this is all the news was about. ISIS and Putin, and ISIS and Putin. And this should have been, the huge payoff for people who had been gradually moving into gold looking for a geopolitical crisis to force the price of gold through the roof. And gold couldn't rally at all. And, the next world, that thematic logic issue, right, that was the current world, and gold wasn't rallying. The next world is when those headlines suddenly aren't on the screen all the time. And if gold can't rally in the face of that sort of thing, that next world is whatever was moving gold before, whatever was depressing it, whatever was holding it down, that's just going to completely take over. And so we caught a huge short there for 150 plus points in gold. And the next summer, of course, this was the Greek riots. The EU is, of course, going to collapse. Every day, all day on TV, people are burning down buildings in Greece. And, Portugal's going to be next. Then it's Italy. And then it is Spain. And then everybody else is going to fall in line. Germany's going to end up leaving. The whole thing's going to fall apart. So this is another moment very, very similar. It highlights the downward force in gold, and it shows you that there's this first world and this next world. Right? And the next world is when those things aren't on TV all the time. Now, this one I talked about just a second ago, ECB does QE. What do? You buy bunds, you short euros, because, of course, in fact, you can just borrow lots of euros to buy bunds. That was the most crowded trade just about of all time in March of last year. And in April of last year, we shorted the bond market because there was only one thing that could possibly happen. And that's when people realize that's a second derivative phenomenon. And markets operate that way. So you can't just assume the bond market's going to go up every day because the ECB keeps buying bonds. All of that bond buying was priced in when people realized QE was going to happen. So on a second derivative basis, it had to expand. The ECB would have had to come out with a new headline every day talking about increasing their buying to really make that trade pay off for people. The next world is when people realize that's not going to happen. And that's when interest rates shot higher and the bond market collapsed. Finally, in this last week, we had a great situation like this. The first world, the world of energy stocks are dying, financials are lending to the energy companies, and they're dying, and the industrial supply chains are blowing up because everybody is depending upon companies as customers who are no longer going to be paying them. And that means Facebook is fine. Google is fine. Right? That was that world. And then what we got last week was a change in that world. When you realize instead, no, this is an asset class phenomenon. This is general risk aversion toward the stock market, which means the thing that's going to fall the hardest is the green fruit at the top of the tree. It's got the furthest to fall. And so what you saw is Facebook just persistently melt down. And, Netflix is down something like 40% in its lows by Monday, right? These are all, the FANG stocks, biotech, the NASDAQ futures. That was all the short. And the short that we put on was in the NASDAQ futures, and it was huge. That was the market that made the lower lows. And because that was the fruit that hadn't yet really fallen off the tree. So that was that next world situation. The third factor, the larger pattern and the mode. And to me, this is kind of maybe the most important one because there's an art to it. Maybe the most important thing you can do as a macro trader is learn to sense that there's this larger financial change taking place. You need to be sensitive to it, and you need to pick up on it. It's just, the gold example was really good. I'll get to that in a second because that really highlights it. But here's a few just really general rules. And again, remember, we're talking about keys to a good setup. So we're talking about finding a set of rules that basically take you out or filter out setups that are just doomed from the start. So if the trend is up and everyone is not exuberantly bullish, don't short it, right? You need to find a situation where if you've really got a trending move up. Now, if it's sideways range, that's a little different. But if you've got a trending move up and it's not the case that everyone is really exuberant, don't short it. If the trend is down and it's not the case that everyone is just desperately bearish, don't buy it. There's that force underneath the surface that's pushing that trend. If it's not exaggerated by emotions among speculators, then you're in a bad situation if you fight it. Another good way to look at things, if a bullish headline comes in and it can't drive the price up, then that shows you something about what's underneath that market. By the same token, if you get a bearish headline and it can't push the price down, that shows you something about what's going on underneath that market. So you need to always be trying to figure out, hey, what's underneath this market, right? That constant force. And so this gold chart, I'll show it again because it's perfect for this. ISIS and Putin, right? That's the first green box. Gold can't rally. That shows you something underneath the market. Greece burning in flames. That shows you something underneath the market if it can't rally. Okay, the sentiment situation. This is hugely important, and I learned this the hard way. I think a lot of people have. This will keep you from getting caught in shakeouts when you see something big. And I'll show you the best example I've ever seen of that really soon. Here, next slide. But so here's what I look at. small and large options trader positioning, futures trader positioning, volatility expectations. Odd lot short interest is very useful. All the major surveys, you can get survey data. When you're trading macro, you can get actual surveys about what people expect the market to do. It's crazy. Money manager reported allocation, RIDEX fund flows, ETF asset flows. You can see where people are shifting their assets around. And the best example of this is, so the August crash hit last year, right? And there's some really good reasons for what happened. But mostly, and we'll get to this a little bit later, it's because we had the narrowest range of all time in the market, and we had mutual funds at 3% cash, lowest ever. And we had this really narrow range with no volume, because when a market gets really narrow, people pull away. Not a lot of people are trading. The volume goes down. And the people who are trading, they need to be trading bigger and bigger and bigger because they're going to get such small moves. And the only way to make money is to lever up. So you got a lot of leverage in a thin market and mutual funds with no cash, and you got a crash. Not a big surprise. But under the surface, there were some other reasons for that. So we started to realize that lots of energy companies were going to go bankrupt, and lots of big banks had lent to them. And lots of industrial companies were about to report really awful earnings and guidance over the next couple quarters because their customer base was just getting slaughtered. So this is all really obvious, great short, right? Except it was obvious to everyone. And if you look at sentiment data, you can see the situation. Everybody was in this trade. So in the chart book, we looked for a squeeze. And this is a chart I posted at the time. First thing you need to do is squeeze out all this short interest. And this is what I saw at that time to get me to point this out. All-time highs in index futures short interest among speculators. All-time highs in odd lot short interest. People with small accounts shorting Google at 20 shares, whatever. Bull market highs in the robo ratio, retail only buy to open put call ratio. In other words, retail traders with small accounts trying to hit home runs on the short side with a leveraged derivative market, right? That's an eye-opener. That's highs in like 10 years we had. Total put call ratio, by liquidity premium, basically people are trading only big indexes rather than individual stocks at that point because they need liquidity to get out fast because they don't have confidence. Multi-year highs in the volatility expectations, equity hedging index, large only buy to open put call ratio. This, again, we're hedging, right? Big traders with portfolios, they're hedging everything out of them. So, and multi-year lows in the bull ratio. So basically everybody was expecting further downside. Everybody was betting on it, so they were hedged for it. Everybody's leaning. So that meant there's no way you can short in September and October of last year. No way. It's just not valid as a setup. However, you wait till December, it's a very different picture. Now, suddenly you've got a market where we know the Fed is going to hike, and yet the market is holding up. How bullish. There's the Santa Claus rally coming. Look at Facebook is making new highs, and Google is making new highs. I guess we're past that whole bad thing, right? So sentiment had totally shifted by the end of the year. And yet we're still coming into a Q1 right around the corner where companies like Caterpillar and U.S. Steel are about to say, they're not going to make any money at all because all these commodity companies are going out of business. And banks are about to write down all their bad loans. And that's all still going to happen. It's just enough time had passed for people to stop focusing on it. And that's when you have the big opportunity for the short. Everything is just as wrong, but people stop focusing on it. So we were patient and we waited, and we put the short on 2 days after the Fed, and that was the monster short that Mike had talked about in the beginning. 250 points, right down. We pretty much bottom picked it. However, I think that bottom is not going to be the bottom at this point, but still, it was a great trade. But that was really important to use sentiment data to figure out that we had to wait because you can't go in there just barreling into a bad situation, even if you're excited about the trade because it looks so good on so many levels. If it doesn't meet all 5 of these criteria, stay away from it. You don't want to lose money and then feel worse about the situation when it does go because you can't shoot the elephant right when it walks in front of you, right? You need to save your ammo for when you have the real opportunity. And finally, we got a short time frame trigger. So this is just basically, once you know the other 4 things, you've got something, it's a falsifiable setup, right? You're not trying to disprove the existence of one green swan somewhere. It's something that is a falsifiable setup. It's something that can be disproven, right? And you believe something based on your objective analysis that you think is going to become obvious to everybody. And again, this takes experience and it takes nuance, but that's the idea. And you've been able to identify the larger pattern or the mode. You can see that force underneath the surface of the market, and you're not playing counter to it. And also, sentiment data doesn't suggest that everybody's leaning with you. Then, finally, it's time for the short-term setup. For me, I like range breaks. I like swift line breaks. I like triangles, ascending triangles, descending triangles. Look for them on the 9, 15, hourly chart. Good example, the bond market short from April of last year. The ECB came in toward the beginning of the range, you see. They were buying bonds, and they couldn't push the market higher, and we just went sideways. And eventually we cracked the interior slope support, and then we cracked the larger range support. And we were able to get very big in that short. And just a week later, it was below the bottom of that chart by a lot. It was a huge move that happened really fast. NASDAQ short from last week. So we got short in the afternoon of Thursday. I also put out notes on Friday morning, right after the jobs report, basically saying the market's going a lot lower. So hopefully one of those two times you were able to get short this because it had a nice short-term trigger, as you could see. You've got the slopes line, and then you've got the range line, right? 4,100 was the range in the NASDAQ 100. That was vulnerable once you break the slope line. And the slope line, you can think of it like the effort line, the red slope line. People trying real hard to push this market back up, right? And, you can see when it failed. And it failed. People were kind of coming in after the job data saying, okay, the bad news is out of the way. The bad news was, of course, job growth was slowing, but yet we were seeing increasing wage inflation. That's the worst possible situation, right? Slower growth, but tightening premise for the Fed. So the bad news was priced in, so people are starting to try to buy this back up once it doesn't break immediately. However, the worst thing is when you get that just back above that red line, and then it rolls back over to that low, right? That's sort of like the nail in the coffin. And then the green line just below it then went really, really, really easily. And we shot all the way down to actually 3,900, which is right where I was looking for. So there's the checklist. Falsifiability, another way to think about this. If X, then trade is wrong. Solve for X, right? Know what that thing is that means the trade is wrong. Thematic logic is a shift in perception coming based on factors that are already there and in the works, but that people aren't focused on yet. The larger pattern in the mode, that underneath force in the market. Identify it and trade with it. Sentiment, you're never going to catch a big trade if you're leaning on the same thing at the same time as everyone else. Try to find a way to see that that's happening if it is. Wait for that to clear up, and then you've got the opportunity. Short-term technical trigger. Find a pattern that shows you something on a shorter time frame that's a view into what's happening in that market, and that it's starting to line up with what you think is coming in that market. So that's the last step. When you see that, now I can see it starting to happen, and that's when you really take the trade. So to tie it together, the gold miner's long is a good one. As far as falsifiability, Fed comes out, hikes rates, right? Gold tries to stab through the lows, can't. And then for about 3 weeks starts to make choppy higher highs and higher lows. At the same time, it's becoming clearer and clearer in the Fed funds futures that this is not going to be a situation where the Fed is doing a series of hikes right away. So, basically I'm looking at it as, you can see where I bought GDX, and actually I shorted dust, but it's the same thing as buying GDX, only a little bit better. That's just implementation. But in fact, I bought the miners. So I bought the miners after gold was making this steady higher high and higher low situation. At the same time, the miners had cut to new lows because the stock market was diving, and they're stocks, right? So they got that additional index pressure to push them down through this 13-level support in GDX. But it popped right back above that, kind of like if you have a beach ball in a pool and you push it down below the water, and it just pops right back up, right? That shows you that that's exhausted. There just aren't sellers left in that. And once you start to see gold acting well, then, your falsifiability is, you take the trade where the red arrow is, and falsifiability is, if it starts to move back down toward that previous low, I know it's a bad trade. Take a size that makes sense for that sort of move, and you're in the trade and you can let it run. Thematic logic, the world that exists right now when I took the trade is gold miners are basically worthless. It even sounds awful just to think about buying gold miners. They're so cast aside at this point. Everybody just hates these things, right? What's the point? And I agree. I've been bearish on gold for years. I just can't see really the point. But anyways, it's a market. To me, it's a big poker game, and there was an opportunity. So the gold miners are worthless. Gold can't rally in a tightening cycle. That was another part of this world. And gold starts to rally. So the shift in perception is gold's been washed out. And the other one is the Fed's not actually in a sustainable tightening cycle. And when those two things come together, suddenly, there's nothing but upside in this. So the larger pattern in mode, the fact that gold couldn't continue lower after the Fed hikes gives you a sense that you got this bottoming action going on. You don't have this underlying force anymore pushing in that direction. And you do, as I'll show on the next slide, have a sentiment situation that shows that everybody was almost artificially pressing these things. Here's the CFTC data for gold coming into that trade. You can see on the top side, you've got the large speculators and the small speculators, the green line and the blue line. You can see as it gets toward the gray zone, which is about where I took the trade, they just dive down to where they add up with the managed money on the bottom panel. They add up altogether, all the speculative money in gold was net short. And that's extremely rare if you look at the history of gold. It was once when we covered our gold short last year in late July, I believe it was, that we got a data point showing this and I covered the trade. And that's the only time, I think, in 20 years, up until this moment, where you had net short gold speculative money. So really, just once or twice in a couple decades, you get this situation. So it's about as bearish as you can get. And that opens up the trade to the long side in the miners. So short-term technical trigger. Now, normally I would be looking at an hourly chart or a 15-minute chart, but in this case, I was just using the daily chart because that was the obvious level, 13. It moved down below it with the stock market, then it popped back above it. And, it's really easy to see that as a short-term technical level. You got your stop in place and everything. And, again, implementation, I use short the dust ETF for mechanical reasons, and I've explained this in several places on our site. Short answer, these inverse and leveraged ETFs have a mechanical problem that has to do with the math of leveraging, and you can actually take advantage of that by shorting them. So I tend to like to do this. It's similar to the DWTI short that Mike talked about at the beginning for like 250 points in a few days, which was a really nice one as well. This worked for me very well, and now I'm in a situation where I've got the position on. I've taken profits a couple times, and I've been up by as much as close to 60%, and I'm also in the short leveraged vehicle, which means I can just kind of relax, because if this goes choppy from here, that's going to go down. That's the beauty of it. NUGT is also going to go down. They're both going to go down if this chops sideways for the next 6 months. This ETF right here will be at 3 if gold miner chops sideways for the next 6 months. So we'll just keep working. Oops. So, all right. So now I want to shift gears. So there's the 5 elements of key elements of a good setup. And now I want to shift gears real quick and just talk about the current market landscape. So this is kind of quickly just let's get up to date. As the new episode starts, we'll look at what happened in the last episode. So over the last 18 months, real quick, Fed ended its QE on the other side of a little crash in November of 2014, handed off to the ECB. ECB started their QE. That led to a bond market meltdown, but stocks didn't really break. And then what we got was this thing I was talking about earlier. The narrowest range year-to-date by August of last year, 2015, was the narrowest year-to-date range in all-time history for the S&P. It was also the lowest level of mutual fund cash ever, right? At 3%, that's the lowest cash they've ever had. So, to me, it was really set up for a crash. I didn't take the crash position because I just didn't think it would happen, and I didn't want to trade a thin, narrow market. But when it did, we spurred the sentiment we talked about earlier, basically the most bearish sentiment situation you're ever going to see. We got the squeeze to squeeze that out, and we rolled over, and we got the big short on after we had a really deep breadth problem in the market. So that's kind of, the path to this point. And at this point, what we have is a sharp market correction in a deflationary environment fueled by slow or no growth around the world, low or negative interest rates in most places, in most big economies around the world. And we got secular headwinds due to demographics, wealth distribution, automation. But in my opinion, I don't think that we're in a situation that's really like 2008 because it's not a financial heart attack. And, I talked about this in the November chart book when I started to essentially flirt with a big short bias on the market. You've got the energy sector is very much like the financial sector back then in 2007 and 2008, in that it's one big problem, right, and this eventually can leak over into other things. But in 2007 and 2008, the problem with the market was the credit producers, and that's super systemic, right? Nothing can operate without credit. The problem now is the commodity producers, and that's a very different situation. They may lead to a credit problem, and in fact, they're leading to some credit problems, but it's not a heart attack. It's a broken leg. Like it's not the same situation systemically, but it does lead to a situation where there's no way the market was just going to roll past that problem without a serious correction. So the serious correction is what we've been playing. We're not playing like a massive market crash here. We're playing the idea that all the fruit is going to be shaken from the tree and shaken pretty hard before we're ready to start eventually putting on some plays to deal with the fact that interest rates are at 0%, and it's really tough for things to get, devalued too much. And there's a lot of forces trying to help things sustain themselves, and there could be some surprises in markets that you think are dead forever now. And when all that kind of starts going, you get to the next wave, and we'll see what that looks like. But right now, the situation we're in is a sharp correction in a deflationary environment that is not a crisis kind of financial heart attack. Major assumptions that are breaking right now. U.S. policy trajectory is not totally different from the rest of the world, but people believed it was. People believed that the U.S. was in an entirely different situation from the Europe and the ECB or Japan and the BOJ. Now, we're in a little bit of a different situation, but the type of aggressive ideas being thrown around that the U.S. could just go off in some kind of boom on its own while the rest of the world was sitting in a deflationary depression is absurd. And that assumption is coming back in right now. We see the euro launching higher at this point, the dollar coming back in. That's essentially the idea that, look at U.S. bond markets too. This is all that adjustment. All the people who believed it was possible for the cleanest shirt in a dirty hamper idea to be a sustainable and diverging and accelerating dynamic are having those bets, they're becoming painful bets and they're getting cast aside. The other assumption we talked about earlier, the high earnings growth tech stocks are immune from the commodity bear market. And it's not true. It's an asset class phenomenon. It's generalized risk aversion. And you've got people who are, of retirement age or approaching retirement age or just past retirement, and you've got most of the wealth of the world in their hands in several different wealthy civilizations, right? All around the world, all the wealth is distributed among people who aren't going to want to take a lot of risk. And they remember what's happened over the last couple of bear markets, and it's going to be hard for them to have a lot of speculative confidence. And so, once you start to shake the tree, the money's going to come out of everything, and that's what we're seeing right now. And I think there's going to be more opportunities to have some shorts and things that people thought were immune. And the other one, Fed tightening means higher interest rates. It's being massively disproven on a daily basis. Some of the next opportunities that I think, I see one thing that's very interesting, and again, what I'm focused on right now is shorting the NASDAQ. I still think that's the best opportunity, but around the next corner, I'm kind of becoming interested in the idea that Chinese stocks are probably badly mispriced to the downside because there's such a popular and widespread mainstream cultural understanding that China is in some kind of perpetual crash and that they can't get anything together to solve it, and mainland Chinese investors have been behaviorally conditioned to panic out of their market. So while that means it's really tough to get speculative juices flowing, it's also the case that probably things are kind of like at absurd levels once people start to realize that there's not no growth whatsoever there. And it could be that, that we're going to start to see this dynamic that I think will be the important one, which is Chinese stocks can't follow any further on the downside when there's just terrible news there. I don't know if that's the case now, but that's what I think we need to start looking for because there's going to be a confidence cycle that goes both directions there, and it's certainly at an extreme right now in terms of popular understanding of the absolute pointlessness of being involved in China. Energy stocks, I assume, were the ones that survived this wave are going to be some of the best opportunities of our lifetime, and I would very much encourage you to watch Gallup and ComDX's webinar in a couple of weeks because they're going to cover this in extreme detail, and I think that probably that's going to be the first next really, really strong opportunity. And again, what I'm focused on, I think shaking more of the green fruit out at the top of the tree in the NASDAQ is still probably the easiest money to be made. So how to follow me on briefing.com. Chart ticker I post under. I also post under the ETFXX ticker. I post ETF daily notes every morning. It's kind of like a main macro note on the markets. For instance, I've posted a number of things over the last 3 days about the bearish pattern developing in crude oil, despite the fact that there's a lot of bottom picking going on there. The macro chart book, every month I look at the big picture trends and what my strategic thoughts are, and that's both under the ETFXX ticker. And now we can go ahead and move to question and answer. And Mike, are you there?
Yep, I'm here.
Okay, so let me see what we got here. Have you noticed, I'm going to have trouble with organizing this process, I think, if you can maybe help me if you see something. And again, we're going to be able to why don't you tell them what we'll do with the questions we don't answer?
Yeah, it's, so if there's a lot of questions, we'll try to get to as many as possible. But what we're going to do is just post a brief column on the site, kind of a Q&A from today's webinar, and Brett will have a detailed answer to all your questions. So I'm sure we'll have a lot of overlap with some of them as well. So and we'll also have a recorded version of this webinar that we'll put on the site tomorrow, and it'll be on Briefing TV at YouTube as well.
Okay, so real quick, I see a few about sentiment data and how to find it. Now, I can just go ahead and plug them because I think I've been an avid user of sentimenttrader.com for about 15 years, and it is terrific. Jason Gefford is a friend of mine. He does a great job, and I would encourage you to check it out. You can find basically every piece of sentiment data ever there. I'm sure there's other places to find them. That's just what I've done. It's not the best for COT reports, commitment of traders reports, CFTC data, but it does have just about everything else in probably the best possible version. So that answers actually about half the questions, I would believe. And so as far as finding different ways to, if you don't trade futures, I would look at shorting the QLD, or I think there's also something Scott uses all the time, TQQ. I think is it a long? I think it's an FQQ. I imagine that's long. So yeah, it's got to be a long. So you can short the TQQQ if you can find liquidity in it, or QLD. There's ETFs. I would prefer that you short a leveraged long ETF rather than buy a leveraged short ETF. But that's just the same reason why I sorted DUF to buy GDX. It's because I buy it in the direction of a fundamental flaw in those ETFs because of the time that helps you. It depends on what your time frame is. So you can buy SQQ. If you're looking for a day trade, SQQQ, or buy QID. And are we too late to trade the dollar trade? I assume you mean, are we too late to short the dollar because of that assumption coming back in? And, I have to be honest with you, I don't know the answer to that. We've got, as I see it, a range trade going on in the euro right now. If you look back, you've still got this long-term force in place. So I would imagine that around the next corner, it's not going to be that easy to buy the euro right now. And I would take that trade and I would show it to you, me taking it, if I really believed that it was a good risk-reward situation to buy the euro. It certainly was on this breakout of this flag right here. And I posted it on the ETF Daily Notes. I don't know if some of you caught that. I posted that morning, before any of that move happened, that the euro could not break on good ADP employment data, and that was likely going to lead to a squeeze above that range and would probably extend it. I think Event had a long in it already. So that was really the trade right there. And it may well extend. Probably will go up and test this 115 area. It would be tough to avoid it. So there's probably further downside in the dollar. How do I position size? It depends on the market. Everything. So there's another webinar. If you're interested in this, there's another webinar where I go in maybe a slightly less advanced version of all these topics, and also get into how to trade individual futures markets, and also how to judge sizing and positioning. And that's called Introduction to Futures Trading. And that's on the Briefing TV channel on the YouTube website. And there's we've done a ton of websites there, but that's a popular one that has that I think does a good job of addressing a lot of these questions, actually. And it will kind of seem like a prequel to the webinar you just heard. Some more examples of falsifiability. Sure. Just think again, the critical question to ask yourself with falsifiability is, do you want to take this trade, whatever it is? If I want to short, a lot of it's going to be technical. It's not always technical, though, but a lot of it's going to be technical. Let's go, let's go with the bond market example that I threw up earlier. The bond market example gives a good kind of summary of that. So bond market, in this situation, when I was shorting the bond market last year, I knew the ECB was buying bonds, and they were doing it with euros. They were depressing the euro to push the German bond market up. And that range formed right there. So I'm wrong if that range breaks out to the upside. There's no question about it. That's a false premise. There's no way that should happen if I'm right that trade is already as crowded as it can possibly get. There's only one thing for this to do, and that's break to the downside. So I can just use my stops as my premise of falsifiability. I know that market should not be able to act that way. The premise, the whole thing, the hypothesis is that everybody's already pushing too hard in that direction for marginal new money to come in and actually move it that way. And that can only happen if I'm right about that trade. So, but in any situation, you just need to make sure that you don't get yourself. It's more a situation of thinking in terms of, if I take this trade, do I understand right off the bat what set of observations will mean I need to say I'm wrong and get out? It's more a mental mindset to never put yourself in a situation where you could take losses and feel more and more confident about the trade. Just avoid those altogether, and you'll never have a loss like that. And I know for some of you who are just starting out, there's no amount of this that I can say that will prevent that from happening to you once or twice, because you kind of just have to learn by pain, probably. But if I can save somebody from that experience, I definitely hope that this will do it. I should have taken this question here about taking the bond market breakout. I should have taken it, and I don't catch them all. And buying bonds, it was a symmetrical triangle breakout in the bond market that we just saw recently, and that was definitely a situation where I had every opportunity to catch this. So you can see the triangle right here. You can see the breakout, and I knew that one of the assumptions was the Fed hiking is going to push up interest rates or push down that market. And that Fed hike is right along in here, right? And so I know that everybody's in that situation. The second that starts to go wrong, you've got a lot of vulnerable hands that can get shaken right out of that. And then you can see that the longer-term force in this market is still the direction that it used to be. So that was one that I should have taken. A lot of times I have difficulty with symmetrical triangles because I like to see them fake out to one side first. I like to see the situation like that. If it had broken down outside of the triangle and then broken back up through the top line of the triangle, I would have been in the trade. And it's just kind of a pre-arranged technical setup that I've used over the years, and I feel more comfortable if it's already sucked in all those orders or run all those orders in the downside breakout of the trend line before it then breaks out of the upside. So I usually take the second breakout of a symmetrical triangle, and in this case, I never got that chance. Okay, so how do I take the trade? How do I trade the basic belief that where oil goes, so goes equities? Is there a room for a future-dated contrarian view? And I assume that basically, Sid, you're saying that if I understand that I know that the oil market is going to wag the equities market anywhere, is there a way to say that when that premise eventually gets beaten, that you're going to be able to move the market? I think that's kind of what you're getting at. So if it stops being the case that correlation is working, then I suppose it depends on what the two markets are doing. I don't know if there's a fixed position I could put on now, but I would be watching, is there strength in equities that's being dampened by further downside in oil, so that I know the second that oil starts to come off the lows, the equities market will blow up through the roof. I might also just be looking for the fact that when oil makes new lows, perhaps stocks don't go down. And at that point, I might start looking long the stock market. But that's already, I think, if I believe that stocks were a good long from a certain point. So I don't know if that answers your question very well. I think maybe it doesn't, but you can email me and explain more what you meant. How low do I think GLD may go? I am firmly long gold at this point. So where does it pull back before you can get long gold again may be the real question there, and I'm really not sure. I got in the position I got because I think that the safest possible instrument there that you can play for a longer-term move in gold to the upside is actually short the dust ETF. And that was difficult to time that one, I suppose, but you're going to have a tremendous amount of mechanical pressure on that, as well as anything that gold does to the upside. Gold is obviously reacting as a contrarian market right now, but it does have a long-term wedge. I don't know if you can see that wedge here. There's a big wedge in gold. I posted charts on it recently, and that just basically means with each lower low, you have a little bit more of a sense of seller exhaustion. And I think that it was kind of easy to see at a certain point that gold would bottom when the Fed finally did hike. So the pullback, the big line is right across here. I don't know if you can see this. The big line is right across here. This is then the key line. So it's 1175 to 1185. I guess if it just shoots right down through that, shakes that level out, and then starts back above that level, I might think you could get long gold at that point. So a move down to 1170 and then back above 1180 might be the point where you take a 10-point risk in gold on the long side. Long S&P short NQ idea. I feel pretty good about it. So somebody asked, how do you feel about the long S&P short NQ idea? I told Scalp a couple weeks ago that I thought an interesting thing to do would be to short the QQQ and buy the XLE as a pair trade. I think that might even be more on the money because there's some of the speculative areas in the market. I think that energy stocks, I've got a belief about crude oil that may be wrong, and I believe that at a certain point that pain will stop the market from moving to the marginal level, which would be in the teens. The biggest producers at their marginal production level would move oil to the teens. I believe there's going to be some kind of political coordination before that point, because in my experience, that's what usually happens when everybody would suffer too much. Eventually, there's a point when people start to organize and come up with a political solution. In the hierarchy, political is below everything else, right? There's no destiny in finance. Politics is at the bottom. And usually there's a political solution when everybody realizes nothing's going to work out. And so if I'm wrong about that premise, then I'm wrong about XLE long, QQQ short. That's simple. So there's my hypothesis. You can take that fair trade, but if it looks like any kind of global coordination is absolutely going to, be no chance of coming through, then, I'm wrong about that fair trade. But right now I think that the fruit that's already rotten and laying on the ground is a bad short, and the fruit that's still green and at the top of the tree is a good short, when the primary thing that's happening is the tree shaking really hard. So at this point, you know what, I'm going to take all these questions, and I'm going to try to get back to guys or on the site tomorrow, coordinating with Mike. And I don't want to take any more of your time today, but go ahead and send in your questions, and we'll keep looking at them, and I'll try to answer as many as I possibly can. Okay, and thank you very much. And Mike, I'll throw it back over to you to wrap things up.
Okay. Yep. Thanks a lot, Brett. A lot of great stuff in there, as usual. So as Brett said, he'll try to get back to your questions by email, and we'll put some of them on the site tomorrow, too, for some content. But if you have any particular questions on the trader service, about setting some alerts or creating some filters and, trying to find, Brett's information and Brett's trading calls, just email me. Again, that's mmidland@briefing.com, so mmidland@briefing.com.
And by the way, Mike, you can also see my contact information on the screen right now if you have any needs.
Okay, awesome.
A trader subscription means that you get access to just talking to me anytime you want. So there's the email. Hit me up and don't worry about it. Okay?
Yep, it's a great point. So, okay, I guess with that I'll wrap it. Thanks everyone for their questions, and thanks everyone for attending.